What average rates of return have IUL policies historically earned? In this episode, and by the end of this video, you will understand that most 20-year periods, IULs have averaged about 9.62%, even during the Great Recession. That was 2000 to 2012. I'll give you examples of that. And you'll also see that in some years, like 2017, 2021, some people locked in gains of 16%, 25%, even 61.33% tax-free. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 48 years, helping people optimize their assets, minimize taxes, and empower their authentic wealth. And so in this episode, I'm going to actually show you proof how max-funded IUL policies can credit phenomenal rates of return, but you don't have to have pie-in-the-sky rates of return to outperform most IRAs and 401ks that are invested in the market, okay? Why? Because Dalbar, who studies investor behavior, says that most people who have money invested in IRAs or 401ks in the market are only earning an average of 3.5%. Now that's pretty pathetic. Dalbar says if they would just buy and hold, they would earn 9.14% before tax. After tax, they would net maybe 6%. So on $1 million nest egg, if people were retiring and had $1 million, that means you pull out $90,000 a year, hopefully without depleting your principal of $1 million, but you're only netting $60,000 or $5,000 a month to buy gas and groceries. That's because of the taxes you pay on those. Dalbar says the reason why most people only average 3.5 is because they're buying and selling at the wrong times. See, most people, when they see the market start to go down and it dips 15, 20, 25, 30%, they finally go, enough already, and they sell. I want out. And they sell low. Then they wait until the market turns around and comes back up, 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 and then they buy high. And so the average investor in America, the average retiree in particular, is only really earning about 3.5%. And that's why the financial services industry came out with the 4% rule. They don't want you to pull out more than 4%. On $1 million nest egg, that's only $40,000 a year, because they don't want to be sued for you outliving your money. And so you have to sign a waiver if you're going to pull out more than 4%. Isn't that pretty ridiculous? So I'm going to show you why max-funded IUL is my favorite vehicle, because I've earned rates of return averaging 9.6. Some years I may not earn anything, but I don't lose. Other years I may make 61% or more, as I'm going to show you. So when we talk about it, I want to simplify it at first. If you understand the rule of 72, you take whatever rate of return you're earning, let's say it's 8%, and you divide that into the number 72, and 8 into 72 is 9. That means your money will double every 9 years. Does that make sense? If you're earning just 5%, 5 into 72 is 14.4. Your money will take 14 years to double. So if your money's in a bank right now at 1%, it'll take 72 years for your money to double. That's pretty pathetic. Now, you'll see that indexed universal life during the worst decade since the Great Depression, what we call the Great Recession, will go from the year 2000 to 2010. Now, in actuality, it took 2 more years for most Americans to make back the 40% loss they incurred in 2008, okay? In fact, they lost 40% twice in that decade. The lowest rate of return, the average, was 7.23% on all of our thousands of clients that had indexed universal life during that period, which means basically this. You could have been Rip Van Winkle, and let's say that you had $1 million, you were about to retire, and you had $1 million in the year 2000 in the market, in IRAs and 401ks. From the year 2000, that $1 million nest egg dropped 40% from 2001 to 2003 after the 9/11 terrorist attacks, down to $600,000, and it took 4 years to make back that $400,000 loss in 2007. and they were barely back to break even. And then in one single year, 2008, they saw that million dwindle down to 600,000 again in one single year, and it took 4 more years till 2012 to get back to the $1 million level. Now, in the first 10 of those 12 years, Universal Life, our clients averaged 7.23%. You could have fallen asleep like Rip Van Winkle and woken up at the end of 2010 and said, wow, what happened while I was sleeping? What? You didn't hear about the 9/11 terrorist attacks and how the market just went, through the floor? And you didn't know about 2008, the mortgage meltdown? It's been horrible. And you run over and you look at your Index Universal Life account that had $1 million in it when you went to sleep 10 years earlier, and you look at it and it's worth $2 million. Why? Because you take 7.23, let's just round it, 7.2%, you divide that into 72, and it's a nice round number 10. In that decade, people that had $1 million, many of them had more than double that at the end of that decade, when most Americans were barely back to break even. So at 7.2%, your money will double every, 10 years. In the first year, if you started out with $125,000, in 10 years, you'll have $250,000 if you're just earning 7.2. And by year 20, you'll have $500,000, and then in the 30th year, you'll have $1 million. We've had many people start out with $125,000 in an IUL policy 30 years ago. They have $1 million today. Now, you could sock away $500 a month and end up with $1 million in 30 years too. You don't have to have a lump sum. But what did I say at the beginning of this episode? The average for me and for our clients, ever since Indexed Universal Life came out, and even Universal Life in 1980, was 9.62%. Let's round it down to 9.6. So at 9.6 annual return, you divide 9.6 into the number 72, and it's 7.5. Your money doubles every 7.5 years. So if you started out with $500,000, which we've had many clients do this, you don't have to start out with that much. Without adding a dime, that $500,000 doubles every 7.5 years to $1 million, $2 million, $4 million, $8 million. And 30 years after starting out with $500,000, they now have $8 million, but it's tax-free. They don't have to pay tax on that. We have a couple in California that has $8 million right now, and it's been generating between 8 to 10% payout. They pull out, between $600,000 to $800,000 a year tax-free. We actually took that couple from the highest tax bracket to a 0% tax bracket in 5 years. The point is this: they don't even need $800,000. They only need $300,000 to live on. And so this is actually growing while they're taking out tax-free income. If they were taking out the amount that most IRAs and 401ks would allow you, they would be depleting it because you have to pay tax on it. You have to pull out 50% more money in a 33% bracket. If you pull out $100,000 in an IRA or 401k, you're only netting maybe $67,000 after tax. And a max funded IUL, you only have to pull out $100,000 to net $100,000. Because it's tax-free. Does that make sense? So let's look at this actually with some statements. Historically, there's a lot of naysayers out there that poo-poo it. Well, I've never seen one of these IUL policies earn those rates of return. Oh, really? So that's your reasoning? Since you've never seen it, you don't think it exists? And I usually go, have you ever seen your brain? How do you know that exists? That's silly reasoning. So here's some statements. This is just an example where many of our clients will diversify. And so they'll get an annual statement. And over here, on one sheet of paper, it shows their money and what each of the accounts. You have a bucket, and you have maybe 5 different places or 4 different places where you are linking to different indices. Those are the indexes I talk about in other episodes. By the way, post a comment here or share this video with somebody that you think would be intrigued in hearing this. But what these numbers are right here, this was an actual annual statement. On a portion of their money, they got 15%, they got 8% on another, 13%, 14.89, and 10.25. Average that. Pretty incredible. By the way, that average is more than 9.6. This is an actual annual statement. Very simple. Here's another one. This one shows 14.89, 16.5, 10.25, 15.07, and 13%. This is actual rates of return. historically that policies have earned, and clients get these annual statements. It's very simple. An IUL professional reviews them with you, and they can reallocate and put a bigger percent over here or there. Watch other episodes about how to rebalance. But let me show you something. If you meet with an IUL professional who understands how to manage this, by gathering once a year minimum, okay, you might get a statement like this, and you can't see these numbers here, but here is where a client was diversified and had $6,000 in a one-year index, $6,300 in a one-year high cap, and another one, we had another $6,000 in a high par index. See, these are different options inside of your IUL policy. And then 1 year no cap, they allocated $18,000 into that one. And 1 year later, this was March of 2020 to March of 2021. In 1 year, they ended up returning 9% in this portion, 12% in that one, 7.25% here, and 61.33% in that one. And so they ended up with the grand total that they had was the $18,000 in this one. It ended up growing to $29,000. These are real statements. Let me give you a glimpse of one other. We had a client of my son's. And what happened in March of 2020? The COVID-19 pandemic. And people panicked, and the market dropped 30%. Now, when there's anxiety, there's opportunity. And my sons called their clients and said, here's your opportunity. They don't happen very often. Instead of just earning maybe, 9, 10, 11, or 12%, you may have an opportunity here to really do well this next 12 months. Why? Because the market went down. Most advisors are going, oh, you've already lost, just hang in there, hoping to get their money back. No, what our sons told their clients, no, why don't you link for 1 year, a 1 year point to point with no cap. Now, you can watch other episodes to understand what that means. But this client started in March of 2020 without adding a dime. They started with $872,000. And because they did that, March of 2021, the market was up 66.33%. If you choose that one, they subtract 5 percentage points off the top, and they netted 61.33%. We had many clients that earned that. But this client made $535,000, over $500,000 in one single year. And his account was worth $1,387,419 a year later. But even more important than that, if the next year, 2022, the market had crashed 40%, he would not lose one dime of the $1,387,000. He wouldn't lose one dime of the $500,000 he made the year before. That's the beauty. It's called locking in your gains and resetting. So these are actual statements. I don't know what your returns will be. I cannot predict the future. All I can do is show you historically what they have done in the past. And the key thing is, even if you fell asleep, you'd probably come out earning 7, 8, 9, 10% based on historical actual rates of return. But if you rebalance like I'm talking about, you can tweak your rate of return from 7.23% up to 10 or 11%, like in that worst decade since the Great Depression. So that's the beauty behind it. Be sure and meet with an IUL specialist that can show you hypothetical illustrations, not just on an average rate of return, but test it, back test it based on the actual market, not just hypothetical rates of return. So you can learn about this in the Laser Fund. If you have not claimed your free copy, be sure and do so by going to laserfund.com, and you contribute a nominal amount towards the shipping and handling. I cover the rest of that. But this is 300 pages of charts, graphs, explanations, and 62 actual client stories. So here is to your brighter future.